Let's try that.
Yeah, try that.
I'm gonna try that. All right.
If you,
I don't know. All right. Let me go into Teams. Oh, yeah. I gotta find that. Hey, where's the mute all button? Yeah. I muted people in meetings before. Oh, okay. All right. All right. Let's see if we get that. Let's try it. Okay, there we go. All right. All right, let's begin. We're now into the chapter 19 valuation that I call a supplemental material, simply because the chapter 19 does not include the economic profit model. So I added this supplemental material, and we will go through the economic profit model. I think it's important to learn this one because it's much easier if you're working with an actual 10K than is the free cash flow model. All right, so here we go. The process we're following is to value the operations of the company. All right, and there's what you call heuristic methods of valuing. There's things like multiples of EBITDA, and then I have one up here. You could do multiples of earnings for that matter. So I have a company that has $5 per share of earnings, and similar companies have an average price ratio of 10, or average price to earnings ratio of 10. So one estimate would say, well, if everybody else is priced at $10 per dollar of earnings, let's do that for this one. And so that would say $50, okay? We will not do that again. Normally, when we value a company, if you are in a valuation class, you would what you call triangulate your numbers with these heuristics. In other words, I will use these heuristics as a check of the reasonableness of the estimate. Okay, because sometimes you just picked the wrong number somewhere, or you made a bad assumption in one of your models, and your models are off. And so this is just kind of a check of reasonableness, all right? But we won't be doing that. We're just going to go right into what we'll be doing. Okay, so let me start out with a very generic looking income statement, the Aubrey Company, and lo and behold, one income statement, all right? What I'm trying to point out is that from here down to here reflects the operations of the company. Okay, so how are you going to pay interest? How are you going to pay taxes? You first have to have the EBIT, right? And except for some accounting adjustments, EBIT is also operating income. All right, so what I'm going to do next is going to show you the procedure we'll follow. So I can break this income statement up into two parts. Okay, I'll stop at EBIT, okay, and then instead of taxing what would be income statement taxable income, I will calculate taxes directly on EBIT. So calculating these directly on EBIT, I get this number, and then what falls out of it is called net operating profit after tax, and we will get into that. So you don't have to write and make any notes. We'll see this many times. Okay, but on the other hand, the bottom half of the income statement, if I would express this interest on an after-tax basis, in other words, I'll take this interest and remove the interest tax shield. Okay, so I hope you remember. How do we calculate interest tax shields? It's just the tax rate times the interest, isn't it? So our interest after tax would be 108. So what's the difference then between NOPAT and earnings? It's the after-tax interest, isn't it? And that's what it is for our very simplified, sanitized example. You download 10Ks, it will not work this way as easily. All right, so here's your NOPAT, net operating profit after taxes. All right, and an easier way to do it is simply to take EBIT times 1 minus T. You don't need a separate row for taxes. So the first one, I would take 15.64 times 1 minus 0.35, and there you go. All right. All right, so let's value this company, if we could. And let's, first of all, let's copy this first table into, actually, you know what? Okay, I know we're gonna have to do this anyway, so why don't we go get something right now? Here, let's get this one first. Let's get this table. If you scroll down, you'll see the net operating working capital. So this is the balance sheet, expressed as we did in chapter 29 for financial forecasting. So we have it broken down to operating working capital, net fixed assets. On the other side, it's just debt and equity. So we have operating assets equal to investor capital. All right, so let's take this table. Let's start with this table. I think it's a better way to do it. So let's start with this table and drop it into a new Excel file. And let's see, we need to know the growth rate, the WACC, the number of shares. So let's put it in about row 5, if we could. All right, I can blow it up a little bit. And then we'll double click this doobie. All right. And, you know, a little beautification never hurt. You don't have to, but it's fine. All right, so this is the left side of the balance sheet. All right, so it's net fixed assets and net operating working capital. So this is also the book value of your permanent capital too. All right, your debt plus your equity. All right. So let's come back up here. Here's the things we still have to get to value this company. Let's start out with the WACC. Okay, then we're going to need a growth rate. Okay, and then we'll need initial debt. What else do we need? Well, we have one more row if we need something else. It's not coming to me right now. All right, the WACC, it's a given for this problem. It won't be for all, but this one it is. 9.42%. Okay, so starting in year 4, this company will grow at a rate of 4%. All right, the initial debt. Let's get that from the document, a Word document. And I have it outlined in yellow, so I know we can find it. There it is. So the initial debt is $27.62 million. These are all the millions, but what difference does that make? So let's copy this. If you want to type in 2762, it would not hurt. In this particular instance, it won't make a bit of difference. Okay, that's my initial debt. Oh, one more for sure. I knew we had one more. Shares. Shares of common. We will have 1.5 billion shares. If you want, we can insert another row here to keep this cleaner. All right, looking so fine. Let's now go and get our 4 years of income statements. And if you're having trouble keeping up, please let me know. Okay, so let's go back and get our 4 years. Here they are. Well, partial income statements, they're not complete, obviously. Let's copy this and drop it into Excel. All right, and then let's move these over so they line up with year 1 for our assets. Okay, now we're going to clean this up. All right, I realize these numbers are all given, but I want the 2 models that we will be pursuing to give you exactly the same number for the value of the company. So here's what we'll do. Let's first of all, let's go to the top here. Okay, we are assuming that growth in year 4 is 4%. So what I'd like to do is let's make sure that the working capital to sales ratio or the revenues ratio stays constant, and so therefore working capital should grow at 4% between years 3 and year 4. So I'm going to say equals the previous year times 1.04. Okay, it's very close, and if you just use the number that was there, you're going to get your values will be 2 pennies, 4 pennies a share off. But I want it to get exactly the same. So let's get that one down to here, and then we'll add these together to get our. Oops! Don't get the 4. I know how to do that. All right. So if you don't do this, you can live with valuations that are slightly different. But this is what it's going to take to make this perfect. Let's also make sure we have live values down here. So that's a given. Let's take this as a given. All right, and let's get a very accurate EBITDA. So let's subtract these two. Let's leave nothing to, they might be right, but let's just make sure. All right, and then depreciation, let's subtract that live. So EBITDA and minus the depreciation. You see, I had to put this problem into the Word document, so I lose my precision that you would have in Excel. So we're going to kind of get it back in a way here. But we'll get it back close enough so that our models will agree. I think that's all we have to do. All right. Oh my gosh, there's still one thing I didn't do. Let's do the tax rate. And this is a very high number, 35%. I hope we never see it again, but the way things are going, I don't know. Because why is that too high? What do corporations do if the tax rate goes up? They pass it on to us, you know, the consumers. So that they don't pay these taxes, we do. All right, so NOPAT. All right, and just if you want to remind yourself how to do it, let's put it on here. There we go. All right, so that's how you do it. And that's just what we'll do here. And I was so brilliant in the 01 section, here the 02 section, that I didn't lock the tax rate. So what do you think happened to all my notepads? They kind of got goofy, didn't they? I'm going to try to remember this time. So let's do EBIT. That will be changing, don't lock it, times 1 minus the tax rate, and I have to remember to lock this. So you people benefit from all the goofy things I do in the first class. So 35%, and I will lock it. I mean, I'll still do something wrong here. I mean, I'm very capable of doing something wrong here, but at least I would tend not to do the same thing wrong twice. All right, let's copy that across. All right. So this is our net operating profit after taxes. This is what our assets have generated on an after-tax basis. Okay, how valuable is this company if it can do this? That's what we'll be valuing, right? So the next thing we'll do, we will subtract from that the change in change in operating. Okay, so this could technically flow right to your capital providers, except for what? You made some investments, didn't you, between year 0 and year 1? So they can't have it all. So let's pick up the difference. So we increased operating capital to 72.76 from 68. Okay, so that NOPAT is available to all your capital providers, except that we have to adjust it for how much we invested. So let's take that one, minus this one. Do you remember, what did we do in that income? What happened to that guy? It had 2 homes, right? It either went to retained earnings, or went to your shareholders as a dividend, or some combination of the two, right? Well, this is kind of the same thing. The NOPAT is the operating income of the company. right? And so you either pay it out or reinvest it. Well, in this case, we reinvested part of it, so some of it is not available to our capital providers. Now remember with the income, that went just to the shareholders, didn't it? Okay, this amount is available to all capital providers. All right, so that would be your creditors and your shareholders. Okay, so what comes from that, we call the difference the free cash flow. All right, we'll call that difference the free cash flow. And let's carry these calculations across. All right. And then the company is not the equity, the whole company is worth the present value of its free cash flows. Okay, well, what's free cash flow 5, which free cash flow 6, 7, 8, and so on? We don't have those, do we? We are just simply going to assume that beginning in year 4, free cash flow will grow constantly. Free cash flows will grow constantly at 4%. So just as we did with income, for income in chapter 4, when we did the dividend model, we're going to do a horizon value here. So we're going to say equals, and let's you know what? Let's clean this up a bit. Whoa, what happened here? Am I going nuts? Why did I put this in column C? I had no intent to do that. Well, I'll be dipped. I don't remember doing that. All right. No idea. Anyway, we will assume that this that the free cash flow number will grow starting in year 4, constantly at 4%. So you go back 1 year. So we're going to do horizon value 3, and it equals free cash flow 4 divided by WACC minus G. So I think so. We will complete our horizon values for the semester in this unit. So we'd have now a total of 5 of them, I believe, different types of horizon values that we've done. So let's put this one in. Equals the next free cash flow. And the first free cash flow where constant growth begins, divided by, and WACC, or R minus G, WACC minus your growth rate. All right, and then we'll add these together. And if you want, there'd be no problem with copying this back to your 1. Okay, and we'll just give this a title of total. Oh my. Total free cash flow. All right. Let's check in a minute. How are we doing? Let me see the chatteroos here. Okay. Okay, you want the free cash flow? It's just free cash flow is NOPAT. Do I have it on there? Don't I? Yeah, it's right there. EBIT times 1 minus T is the that's the NOPAT. And then the free cash flow, let's give that a definition then. Oh, what's the total free? Let's just go up to here, free cash flow. Okay, free cash flow would be NOPAT minus your change in operating capital. Okay. So we start out with the NOPAT. We calculated the change in operating capital. That was the difference between 72.76 and 68, right? That gave me the 476. I subtract that number from the NOPAT, and I get the free cash flow. Sorry, I didn't have my chat. I didn't have my chat live. I wish I would have. Didn't know I didn't. Okay. So cell C20. Let's examine cell C20 if we could. Would be yeah. That's just 18 subtracting 19. But I hope we get the idea of what you're doing rather than just cell minus cell. But you're taking the NOPAT, the operating profit, and subtracting what part of that you invested in the company. Are we okay on that now? How are we doing on the horizon value? Did that work out? Okay, so the horizon value okay? And then of our total free cash flows, are we good at this point? Because we're just going to keep building up, and if you get something you haven't done, you will just get further behind. This all builds on itself. So are we okay? All right, well, I will proceed then. Thank you. We are proceeding. Okay, let's proceed. All right, then we're going to value the operations of the company. Value the operations of the company. And that is the present value of the free cash flows at the WACC. Right, so let's do that. Equals NPV, oops, November instead. How about NPV? And then let's get our WACC discount rate, comma, and we'll discount these free cash flows. And hopefully, yes, 138.04 is correct. And if you look in the Word document, you will find exactly the same number. All right, continuing. Let me show you what you just did. So you don't need to, this is in the document too, but I just want to do it for you. Well, I'm going to take 4 cells here and underline them. And then I'm going to take 3 cells and put a right on them. All right, and then let's underline this one and this one. All right, see if I can do this. Okay, here's what you have. These are your market value. This is the market value balance sheet. Where do you find those? You don't. You create them. So let's start over here. What we will need to find. We have debt. We have equity. And then we have market value of the operating capital. Okay, now over here you have your operating assets. All right, now you notice, what do I normally have up here? Net operating working capital. I normally have net fixed assets. All right, we're doing market values now, right? These are not actively traded. So could I go through a company and say, well, this machine's worth this much and your car is outside of it? Well, no, they're not actively traded. You have no idea. So what you do is you come over here and you finish this side. And what we just did is we know what the market value, well, okay, we have an estimate of the market value of the total operating capital. So we're going to set this number equal to this number. All right? And then one of the things we did, we found the initial debt of this company. So we take our initial debt and we come way up here and we said it was 27.62. Right? So this is what you know. Right? So now we set the value of the operating assets equal to the value of the capital that's funding it. So this we can observe, this we can't. So we just do this. And now how do we get the equity? Well, the debt plus the equity are the operating capital. So I simply take the difference. And there you go. So this is what we are doing in effect. So we're going to come over here and do it. Okay, but one little change, it's not a big one little change. You notice it says here, it doesn't say value of the company, it says value of the operations, all right? So we technically have to add back non-operating assets. All right, so we have some companies that are cash hoarders. Do you think all the cash that Apple is holding is all operating cash? Do they need that amount of cash to meet their transaction requirements? Not even a little. Okay, so what you would do if you were valuing Apple is that you'd go back into their balance sheet and you would estimate a reasonable amount of cash that they would actually need for transaction purposes, and then the difference you just set as a non-operating asset. Or if a company holds marketable securities, or if a company holds the stock of another company that that's unrelated to their operations. All right, so you'd include all those. They're not part of operations, but they're still valuable. You will even add back, if you went into the very fine details of valuing a company, you would add back any of their tax credits and things like that. Okay, not in this class. We're going to say that these are all equal to 0. All right, and so now we have the value of the company. What was this, AC, Aubrey Corp? Yeah. All right, so we'll set this as the value of the Aubrey Corp. Okay, that's just a procedural step. I mean, if you are taking Finance 339 or one of those, you might be doing something like this. All right, let's come over here and let's subtract the debt. All right, and we know the debt is equal to 2762, and the difference is the equity. All right, and we'll say equals. We'll take this one and subtract the debt. Oh, you have the equity. That's what I did over here. Where did it go? That's what I did over here, isn't it? I'm just showing you with the financial statement, that's what we did. All right, let's come back here. All right, so then let's take our shares. And I think I have set it up with 1.5 million shares. And then this is our intrinsic value per share. Notice, did I put the word price in there? I did not, because I don't know the price. I just know the value. Okay, forgive me. The value as estimated by the free cash flow model for this company. Okay, so our value per share, we'll just take the equity in total and divide by the number of shares. So we have our first price estimate, $73.61 per share. All right, let's come back over here a minute. All right, let's do a book value balance sheet. All right, and let's see, how can we do this quickly? I don't want to take all night on this. Let's copy this. You get some goofy numbers, but don't worry about it. Perfect. Okay, so just delete these and delete this one. All right, so in this case, we have net operating working capital, we have net fixed assets, and we get those right from the year zero. So let's go up and find those. Okay, I see 1275 for working capital, and I see another number. Let's copy it down, and we'll add these together. Nothing new here. All right. Then let's get the debt. Okay. Now we made the assumption that the book and the market value of the debt are identical. So let's just go get our debt. All right. And then how do we get the book value of the equity? How do we get the book value of the equity? Well, here you go again. You have to back it out. Well, this time I know the book value of the assets, or at least I have an estimate of it. They're all estimates, of course. And then that means the equity is worth the difference, right? Oh, this is not good. What did I do wrong? Okay, let's Control Z that. Why did that work? I don't know why. Let's see, equals this one minus.
I think what you did.
Do I got a circular here? There it goes. What did I do? Tell me, I'd like to know.
Selected that in 20 instead of the number.
Oh, really?
Yeah, I think so.
Okay, I pushed the slide over arrow and I must not have hit it hard enough. Okay. So anyway, 4038. So put yourself in the shoes of the shareholders for the Aubrey company. Should they be happy with the way their company's being managed? And what would tell you that? Okay, well, we have one indication. We're going to calculate the, what's called the market. Come on. Market to book ratio. Okay, and if you want, let's underline this one, make it look like a ratio. Okay, so the market to book ratio. Okay, where do we get the market value of the equity? Right here. Where do we get the book value of the equity? Right here. So let's just see what they are. Let's get the book. Come on. All right. So let's tell a story about this. I'm with a bunch of 8th graders from Barron, and I'm in a junior achievement activity and we're showing them things about finance, well, what do you explain here? Well, what I'm going to tell them is that the shareholders have invested $40.38 in this company. And if they were to sell their ownership in this company, well, this is what they put in. What's it worth? It's actually worth and being traded actively for $110.42, or at least an estimate of what it should trade for. So in other words, let's do the full market to book ratio. So this company has earned $2.73 for every dollar that the shareholders have invested. So you're doing pretty well, aren't you? Well, it turns out, I think I have a number in the Word document that the large corporations, the S&P 500, probably do a little better than this. But that's not awful. Okay. So anyway, that's just a little side note. Let's keep going. Okay, we got to get into our next model. Now we're going to value this. I skipped a part. Dang it. Okay, there's nothing wrong with what we've done. I wanted to show you one more thing, and I can still do that. So if you would please come over here and recapture NOPAT. Okay, and please recapture NOPAT for the full 4 years. So we've done everything correctly so far. I have no issue with that. And you know what? Let me. So let's do a year here. I sound like a vendor at a baseball game, right? Year here, instead of beer here. You don't have to laugh all at once. Okay, so anyway, year 0. This is year 1. Yeah, thank you, appreciate that. All right. And let's center it. And let's underline and make it look nice. All right. There, if you were a big fan of your textbook and you wanted to do this exactly like the textbook does it, they don't do it. They don't do free cash flow like I did up here. Okay? Let me show you what they do. They add back depreciation. Oops. Now, do you recall in your last assignment from financial forecasting, we had that measure. It's called we added back net income. We added back depreciation. It's kind of the same thing here. We take NOPAT and add back depreciation, and we get some kind of I'm going to call it. I have no better name for this. Your textbook doesn't create an intermediate step here. They go right for the free cash flow without ever doing this intermediate step. I like to show it in steps. So I'll just call this operating cash flow. All right, and let's try it. So add back depreciation. I think it's 709, yeah. All right, and so we'll add these together. All right, and then we will take our change in net operating working capital. Oops, net operating working capital. All right, so you notice it's not operating capital, it's just the net operating working capital. So I'm going to come back up here. Okay, so that went what? From 1275 increased to 1364. So we'll take this one minus this one. Okay, then, you remember the dirty word? Investment. And that was what? Ending. Oops. Let me give you a little. Ending. Some of you will remember this, I'm pretty sure, but I'll just do it again anyway. Ending net fixed assets minus beginning net fixed assets, net fixed sunshine, net fixed assets plus depreciation. Okay, so let's do that. So our investment equals the change in net fixed, and add back the depreciation. Okay, and then we will calculate free cash flow. All right, and that would equal the operating cash flow subtracting your change in operating capital, subtracting the investment. And lo and behold, I hope we'll see that, and let's copy these across. Should work very nicely, I hope. And you can see that those are precisely what we have here. So I don't know, let's highlight these in yellow maybe, so you can see that those are exactly what we did here. And I'm not going to redo the evaluation because from this point on, the steps are identical to what I've already done. Is that okay? Now, why am I showing you this? This is not the way I would do it. Okay? But in your assignment, you are given investment, and you're given investment, and you're given the change in operating capital. Nowhere in the problem will you find net fixed assets. So you have to do that problem. That's problem number 23 in chapter 19. You have to do it this way. Okay, but once you have the free cash flows, everything from that point on is just what we've already done. So I don't care to spend time repeating all that. All right, let me check in. How are we doing? You clicked that. Thank you. You are right. I think that's what I did. I wouldn't doubt that a bit. I thought I clicked the right arrow, but I must not have. All right. So free cash flow. There we go. We're done. Now we're going to move into another model. And this is going to be if I were to do this problem, this is the model I would use. The economic profit model. All right. And the economic profit model also uses as its metric the operating income of the company. So it also values the operating income, but in a different way. So let's start off with our NOPAT, net operating profit after tax. And let's get it from above. We don't need to recalculate it. All right, and then this time we're going to do something a little different. This is similar. This is why I did that little unit on EVA for you. Okay, what EVA does, it calculates the capital charge and subtracts it from the NOPAT to get the economic income. So that's exactly what we'll be doing. All right, so let's do our capital charge. Okay, we'll do our capital charge. So let's come back up and see what we're working with. Okay, our capital providers have provided for us $68 million of capital. What is the absolute minimum they expect us to earn on their investment? Well, not so much investment, part of them are creditors, right? On the capital that they've provided. Well, they expect us to earn at least 9.42%. Okay, so any amount that they earned above 9.42%, if you're using the EVA, we call that economic value added. And with the economic profit model, we simply call it, that's your economic profit. All right, so we are going to charge against that NOPAT 9.42% for the rental cost of using the capital provider, $68 million. All right, so let's do that. So we have $68 million of capital times 9.42, and make sure you lock that. I know how not to do it. Okay, so just to please the capital providers, we had to earn at least $6.4 million. Well, we've done better than that. So we've actually created value. And you know what? I mean, let's look over here. Would you have expected that? Well, given what we've already done, can you see that we did what? We parlayed $40.3 million of equity investment up to 110.42, didn't we? So wouldn't you, based on what we've already done, expect this to be seeing a economic profit? Yeah, we are. Okay, so that's just the difference between these two. Hope I get this one right. There we go. All right, let's do this for 4 years. This is only the first year. Year 2, year 3, year 4. All right. You know what? Yeah, we can probably do this. Let's move this so we can use it. You don't have to, it's not necessary. All right, so just remind yourself that you're subtracting here. So we take out the capital. Okay, now, is this the last economic profit I expect to see from this company? Well, no, this company will continue to operate. And how do I capture the future economic profits from this company? One more time. Give me an H, give me an H, give me an H, 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 give me an O. It's called the horizon value. Okay, in this case, exactly the equation we use for the free cash flow model, except that it's, instead of free cash flow, it's economic profit. So we'll do EP, economic profit, year 4, divided by WACC, and what do I put next? Minus, 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 going once, going twice, G. All right, so let's do it. Okay, and this is horizon value. We can make a note of this. It's not a bad thing to do. Year 3, isn't it? Okay, so continuous growth begins in year 4. To set the horizon value, we go back 1 year. Correct? Okay, so let's do it. Okay, so now I want WACC minus G. WACC minus the G. So I get 78,526. How are we doing? I don't want to get ahead. You click that. I do remember that. Okay, so proceeding. Sorry. All right, and everything okay? So we have the horizon value done for the economic profit model. No problems finding that? All right. Oh, could you show you got the, yes, I can. The capital charge, let's do that. Okay, the capital charge is, let's do it all over again, in fact, equal to, we come up here, okay, and we have 68, so capital charge, we have $68 million of capital, and the charge against that, or the rental for using capital providers' inputs is the WACC. So we're going to multiply that times the WACC, and we will, with all certainty, lock that. Okay. And then you subtract the capital charge from the NOPAT. So there's our fine cap charge, and we will reduce it by the NOPAT. That's what we get. How are we doing? Great, all right. Sounds good, let's keep going. All right, now the free cash flow model and the economic profit model are algebraically identical. So I recall in my corporate valuation class, I actually held the class responsible for starting with the free cash flow model and deriving algebraically the economic profit model. And I did it in class a few times, but I actually put that on an exam. But anyway, they're identical. So we should get exactly the same number, right? So let's follow kind of the same procedure. Once you get a what? A horizon value of any of the metrics we've used, whether they've been dividends, whether they've been cash flows, you do what? You add the annual one and divide and the horizon value together for our total. So we're gonna have a total here, are we not? Total EP. And that's what we get. So now we're going to find out, I'm not going to call this value of ops. No, 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 no. This is just the present value of the EPs, economic profits. Okay. So and this would be, well, this present value is the present value. R equals the WACC. Okay, so let's do a present value of these three. And once again, we'll employ the NPV function. All right, and you know the discount rate. You can go up and get it as fast as I can. So let's start with the WACC, followed by comma, and now the cash flows that you're dealing with. In this case, they're economic profits, aren't they? There we be. All right, 70.04. Now that's not the same as 138.04, is it? Okay, but you're measuring something different. We are measuring how much we have increased the value of the investors' capital. So the investors have 68 million invested in this company. What have we done with that? And what are we projecting we'll be doing with that over the next however many years? We're saying with this analysis that we are going to increase it by 70.04. So let's start over here. Let's add back the initial. And of course, we know we have that identity. Investor capital equals operating assets. Well, that barely fit. All right, let's get it. Right, we add these together. And we have the value of the operations. Sorry. Yeah, yes, that's right. Okay, and what do we do next? Okay, it's procedural only. Non-operating assets. And then he lit the fuse to the dynamite. Okay, that's going to be 0, right? Okay, so put a 0 in there. And then we'll add these together, which doesn't change a lot. And now this is the value of the company. So it's the Aubrey Company. And then we will subtract the debt. And we'll get the equity. right, so what do you know on your next test when you get, when you work the problem on the exam that deals with these two models? Well, I'm gonna have you take a company and value it both ways. And what do you know about your answers to the value of the stock? It better come out the same, right? Or you made an error. All right, so that's all we got. Well, we can do the shares, I guess, can we not? We got 1.5 million shares, 5, and then the value per share. All right, there we go, 761, you don't need that many decimals. And the other model said the same thing, 7361. All right, so last questions here before we continue. So far, so good. Anything we didn't quite get, we can certainly fix it. All right, then if you would please, go to Canvas and download the file that's in this unit. It's called, what is it called? Let me see. It's called, yeah, Chapter CH19XL. Okay, and start with the first tab. Your copy doesn't have this third tab. So I'm going to reload this after class so that you will also see, you have 3 problems to work for this chapter. And only one of them actually comes from the book. One of them is the problem 23 that is in the book. And what I've done, I've basically just inputted it for you. Okay, and then you have to use the free cash flow model here. You can't use the, you cannot use the economic profit model, and you have to use the version of the free cash flow model that you specify investment rather than the change in net fixed assets. So that second version we use, you have to use that for this because you don't have net fixed assets here. This is all they tell you. All right. So see if you can do it. Now let's go to the 2 problems that you have that I've invented for you so kindly. All right. Let's do the second one first. Chapter 19, horizon value. Value. Well, that's interesting. This one is all but a dead ringer for what we've done. Yeah, it's a dead ringer for what we've done. So you just followed out 4 years, put a horizon value in year 3, and away you go. You have to do a little bit more. You have to find EBIT, right? How long will that take? All right, let's go to the problem that's completely, not, I won't say completely, but it's a bit different. Okay, that'd be this one. I'm gonna blow it up so you can see a little better. All right, this is a company that is what I'm assuming to be a special purpose entity. Okay, what are special purpose entities? There's something that a company does on the side. Okay, now the very fine Enron company set up a series of special purpose entities, and they basically took the debt that was on their balance sheet and switched it over to the special purpose entities. So when people examine their balance sheets without going into all their special purpose entities, they were doing fine. So they basically took that debt off their balance sheet. Well, this is a company that's going to last only 3 years. I use an example, say oil exploration. So I'll set up a company that will explore different sites for oil, and once you strike one, you get out of there and go to another one, so we're gonna set up a company here. It will last only 3 years. So these are the revenues, the incomes that we expect to generate, all right? Now, what I want you to be able to do is you're gonna do the free cash flow model, you're going to use the economic profit model. I want you to get exactly the same number, all right? You can say I'm being a tad anal, and that's probably right, but I want you to get the exact same. So we're not going to use these copied values. So let's do this if we could. This one is okay. If we just stop, we'll just, even if this one isn't exactly right, it will work. This one will not. So let's do this. You see over here, I've given you the cost of debt is 6%, right? Okay, the way we will calculate the interest is to take the cost of debt times the beginning of the year debt. So we're going to take 6% times, and you can see on the today's balance sheet. Oh, did not mean to do that. What did I do? Oh my gosh. Okay. Oh boy. I'm in deep doo-doo here. Let's see. What is doing this to me? Oh no! Okay, wait a minute. Oops, I can control Z that, can I? Yes. Oh, I won't do that again. I just want to get this open enough so you can see the words a little better. There we go. I forgot about that. The story's up there, and it'll open the cell to fit the whole story into one cell. Okay, well, I don't want to do that. Anyway, okay, we start out today. Here's today. So that's your current year's balance sheet with debt of 118.4, all right? So I'm going to say for year one, we will pay 6% interest on that debt. So let's come up here. And I'm going to say equals 0.06. I don't want to, what did I do that for? Do we type things in? I hope not. 6%, lock it, times the beginning of the year debt. And that's right here. And then we can copy that across. See that little difference? Just enough to make your models not agree. Okay, then we have EBT, and I think this is an active cell actually, and it is. So these are real cells, they're not just numbers. All right, then the taxes. Unfortunately, those were given. All right, and if we want these models to dance together, we have to have the same taxes for both models. So let's do this. When we do our 1 minus t multiplications, the t that you use when you multiply EBIT times 1 minus t, the t that you use for the models all to dance together has to be the exact t that you used here. All right, so let's make sure that it is. So I'm going to say equals 86.5 times, and we'll come over here, and we'll catch our 25% and lock it. We'll do that. Now our models are going to sing the same song. They're going to give you exactly the same penny to penny value. Right? Now what you have to do here is you have to calculate the WACC. All right? And you can see it's the same equation we've used previously. Debt to capital times the cost of debt times 1 minus t plus equity to capital times the cost of equity. All right. So cost of debt, given. Cost of equity, given. Okay, what do you use for debt? Well, we are going to highlight it in yellow. You take it right off the financial statements. So our debt in the WACC equation is today's debt. So let's highlight this in yellow. We're going to use this debt for WACC. Just the year one, or year zero, forgive me. Okay, where do we get the equity? Well, There it is, right there. No, 9, never, not, never. Come back up here. You take the shares of common times the price per share. So remember, multiply these together to get your market equity. You always use market values. In fact, look at this, look at this. I couldn't believe it, but last semester, I assigned this problem. It says right here, equity. See, there's your debt, there's your equity. Number of shares times the price per share. And the first person that wasn't getting my check figure, I looked at it, person had used the book value of the equity. Right here. Okay. Don't do that. Use the market value of the equity. Right, then you get a WACC and life is good. Okay, so where do you start all this? I'll give you just a start and I'm going to leave the rest to you. So why don't we say start a year going here. And let's start with 0. For 3 years. That's how long this company will exist. We'll underline that, we'll center it, make it look so nice. Oh my gosh, it looks nice. Okay, where do these valuations start? Where do our valuations, they start with Notepad, don't they? So let's start with a calculation of Notepad. Okay. How about year 0 Notepad? No. Year 1, yes. Equals. How did we do it before? We've done it several times. EBIT. Okay, oops, let me just take a little pause on that. Let's come over here. Except for some typically minor accounting adjustments, that operating income and EBIT are the same. Okay. I did this, and I was showing it to a accounting professor years ago. And he said, no, that's not EBIT, that's not operating income, it's EBIT. I said, okay. Yeah, there are some adjustments you can make to EBIT to find operating income. All right, so let's leave it at that. Actually, this is actually before tax operating income. That's what it is. But what are we going to do to get net operating profit after tax? We will multiply it by 1 minus t, won't we? Okay, so let's start our first year. Let's get our operating income times 1 minus, and let's get our tax rate. And remember to lock it. F4, Command T, $sign, however you do it. All right. And what do we do next? Let's start out with the free cash flow model. We can do either model. And as I've told you, if it were my choice, it would be just the economic profit model. Well, we're going to do both. And what followed the Notepad? Okay, let's do our change in operating cap. Okay, so let's go back here for a minute. Okay, so we did what? Let's go back. So we did what? We did our EBIT 1 minus T, change in operating capital. So we came up here and we took the difference between the 72 and the 68 numbers. Okay, let's follow the same procedure here. I don't want to take too much of the fun out of this for you, because I think you're perfectly capable of doing this, but let's just make sure we get everything right to start. All right, so net operating working capital. How do we get that? We did it with the financial forecasting. It's your operating current assets minus your operating current liabilities. Net fixed assets, just go get them, go get them. That's net PP&E, same thing. Add these together. Okay, now we have our debt, our equity. Okay, and debt, where do we get debt from? Two guesses, right there. And then we get equity. These are all book, aren't they? Okay, there you go. So what's your operating capital equal to? Well, we already know the answer, but let's make sure we do it anyway. There you go. So what did I basically do? I subtracted 180 from both sides of the balance sheet, didn't I? That's all we did here. Okay, I took it off the right side, went 360 minus 180 over here, right? Oh yeah, too easy. I didn't even earn credit for this. Okay, now I'm running out of time. I just want to make sure you're clear on this. Since the chancellor was so kind and gentle and graceful to remove one of your class periods, and one of them happened to be a class period in which you would be in my class, we're 1 day shorter now the rest of the way through. So I have to move this assignment up to this coming Tuesday. So this assignment will be due on Tuesday of next week. All right? Excuse me. So make sure you turn it in by the beginning of class next Tuesday. All right? I had no say in giving you that day off. I personally wouldn't have done it. It wasn't up to me. So just make sure you have this done by Tuesday, and that would be all three of these by Tuesday. All right? So I'm going to open up for any final questions, and then I'm going to head out.
When I download chapter 20, or the problem 23 wasn't on it.
Yeah, I mentioned that already. I'm going to upload it again, and I said this one wouldn't be on yours.
Okay.
Yeah, I'm going to re-upload it to give you that problem. In fact, I think I'll even put the debt in. So yeah, you can start on these. These are exactly the same, but this one I'll have to add that to it, and I'll do that. But thank you for reminding me. Make sure I'll do it right away. Well, some people are already downloading. Anything else I can do before we leave? All right. Have any